5 seconds to the open. Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to you all around the world. Welcome to this episode of the Follow the Money podcast. Today's episode number 504. We've entitled America's Retirement Reckoning. And as you can tell, today we're going to be talking about something that affects nearly every American household, and it may be one of the most important financial conversations we can have. When you step back and you look at the numbers, the picture becomes very clear. America is facing a retirement reckoning. Recently, BlackRock, which is the world's largest asset manager, released its 2025 annual shareholder letter, and in it, they cited a survey of 1,000 registered voters, and when they were asked how much they believe they need to retire comfortably, the average answer was $2.1 million. Now, here's the sobering part about that. 62% of those surveyed said that they had less than $150,000 saved already. So that is obviously much more than a retirement gap, right? That is outrageously different from what they envision they're going to need in the future. And at the same time, Social Security is projected to face automatic benefit reductions in the early 2030s. On top of that, you have healthcare costs that are continuing to rise. You have inflation that just keeps compounding quietly in the background. And more Americans are finding themselves unretiring because the math simply doesn't work anymore. So in today's episode, we're going to zoom out. We're going to talk about the retirement crisis in America. And I'm going to walk you through a smarter framework, what I believe is a smarter framework anyway, to building a retirement that can actually withstand volatility and inflation and all the uncertainty that undoubtedly lies ahead. You won't want to miss this one. Let's dive right in. All right, so let's zoom out and talk about this brand new BlackRock 2025 annual letter that included survey data from 1,000 registered voters. The average American said they believe they will need about $2.1 million to retire comfortably. That sounds pretty high when you consider that many people don't even have enough money to make it from paycheck to paycheck, right? So the average American looking for around $2.1 million in order to retire comfortably. Now, 62% of those surveyed said that they had less than $150,000 saved. So that's roughly 7% of what they think they're going to need. And that obviously is a big problem. Now, what I want to do in this first segment is I want to break down some of the issues that we see around retirement. And a lot of the things that we're facing today are due to an economy that is simply, let's just be frank, it's in many ways become unjust. Right? Let's look at the productivity, for example, in the United States, which has risen dramatically over the past 5 decades. You've seen improving technology and improving efficiency, and you've seen corporate profits just explode. In fact, they're at some of the highest levels we've ever seen. In fact, they're on all-time highs. Asset prices have obviously gone up during that whole time. But you know what didn't? The very thing that's important to your retirement, the very thing is your wages, right? Because your wages are what is going to allow you to invest in those assets and to be able to grow a retirement account. What the data show is that wages did not keep pace with productivity the way that they did prior to 1971. Now, if you know anything about economic history, you know that 1971 was the year that the United States was fully divested from the gold standard, the international gold standard. And we moved to a purely fiat currency system. And that obviously shifted things because the closer you were to the printing press, to the capital markets, to financial assets, the monetary spigot, if you will, the more you benefited since that time. Asset holders and those who, own investments they have captured a disproportionate share of the productivity gains. And meanwhile, wage earners, who up until about 1971 were pretty much getting wage raises based upon rising productivity, since 1971, they've decoupled. And so now wage earners are not earning the commensurate amount of the rising productivity, right? So as productivity rises and as corporations make more and more money, the average worker out there is not keeping pace with that trend through his wages. Now, if you owned stocks or real estate or businesses, then you participated in that compounding as productivity rose and as investments went right along with that trend going higher. But if you live primarily on W-2 income and you never really accumulated meaningful assets, then you didn't, right? And that's the divergence that we're seeing today, is that so many people relied upon W-2 income and didn't also invest a large portion of their income, or at least a meaningful amount. So now what we have is we have a situation where many people are in retirement or facing retirement, and they don't have the amount of money that they would like to have in order to retire comfortably. So retirement is, of course, not funded by the gains in productivity. It's funded by the gains in the assets that you own. Now, layer on top of all of that the many hard realities that many people simply can't control. These are out of our control. Social Security's trust fund projected to face shortfalls in the early 2030s, right? I saw just recently that the latest date where we would begin seeing these benefit cuts would come in 2032. It just keeps coming closer and closer. When I wrote my book, Bankruptcy of Our Nation, it was like 2036, 2037. When I revised it, it was like 2035, and now it's 2032. And so without any kind of reform, then Social Security benefits are simply expected to be reduced, which is incredible considering that inflation is not going to be reducing, right? And we're not going to see, the cost of living in general go down, I would imagine. So with benefit cuts for the most vulnerable population, those in retirement, that's a negative development as we look forward. Let's think about healthcare costs, right? Healthcare costs continue rising faster than general inflation. Have you seen pharmaceutical prices? They remain outrageous. I know that there have been efforts to bring them down, and many drugs we've been able to see them come down, but pharmaceutical prices are, again, just out of control, especially when you compare it to other nations. America pays a lot more for pharmaceutical drugs, and we could state reasons for that. But overall, it's a reality. It's a harsh reality, that Americans who are nearing retirement are facing. So too, longevity has increased, right? Many people will spend 25 to 30 years in retirement. That's not something that many people have faced in the past, and that's actually a great thing. It's good that we're living longer, but that, of course, is coming with a cost. You have to be able to afford to live longer. On top of that, one of the most meaningful risks that people nearing retirement face or even in retirement, is that sequence of returns risk. I've talked about this many times, but if you retire in a bear market, let's say you go back in time and you retired in 2008 during the great economic crisis, and I actually knew people who went through this, and they had to unretire, which we've been seeing more of, by the way, as of late. But imagine retiring in 2008. If you retire into a bear market and then begin withdrawing from a declining portfolio, you can do permanent damage to your portfolio. Even if markets recover later, those early withdrawals may have already completely impaired your capital base as you go forward, right? It could really destroy your hopes and dreams of what you were going to be able to pull out of that retirement account once you actually need it. So too, inflation is compounding that pressure, right? A 3% inflation rate cuts purchasing power in half over roughly 2 decades, about 24 years. Every 24 years, a 3% inflation rate cuts your purchasing power in half, right? So that means that during a retirement that lasts for 24 years, you could actually see your purchasing power just simply cut in half, right? That is due to our fiat currency system that has no backing and our spendthrift leaders in government who are spending money like a drunken sailor and then, having to pay interest on top of that. It's really gotten outrageous. So, if you're nearing retirement and you're feeling this stress, it's understandable. And that's why we're seeing more Americans unretire. I don't know if you've been seeing this word in the media lately, but they've been talking about the unretiring trend where Americans are stepping away from work and then they run the numbers and they realize, wait a minute, my income is not going to work out. It's not going to stretch it far enough. So they have to go back to work. Now that creates stress, obviously, for households and for individuals, but it also creates stress in the labor market where you have these delayed retirements that limit these transitions from a younger generation to an older generation. That just complicates the whole workforce planning for corporations and the whole issue for individuals as they're trying to find a job. So, most Americans know that they're going to need a lot more than what they have when they go to retire. The truth is, most people just don't have it. And as I mentioned, since 1971, we have seen those tailwinds that once lifted wages right along with productivity gains. We've seen those evaporate. So individuals are not continuing to keep up with the productivity gains. Their income is simply not keeping up. So government promises obviously are strained. The government has way overpromised. It's certainly not going to be able to make good on its promises unless it makes remarkable changes. And that's going to take political courage, and no one sees that in the future. Of course, you have volatile markets, which add to that stress because of that sequence of returns risk. That if you begin to retire in the wrong year, it can really have a dramatic impact upon your retirement account balance. Healthcare is expensive. People are living longer, right? That's the landscape. That's where we're at. So if we're going to navigate all of this wisely, we have to look at it honestly and clearly and realize what the truth is, right? We just simply have to accept where things are because we can't change them, but we can change what we're doing. And that's what I want to talk about in our next segment. I want to show you a simple framework for thinking about retirement that goes beyond the target date funds, which BlackRock and these other Wall Street institutions have been pushing upon Americans as a way to catch up. And I'm no fan of the target date funds. Probably won't get into that today, but that's mainly been, Wall Street's answer to the retirement crisis is, go invest in our, these target date funds that have all these fees. So that's not actually, in my opinion, the smartest way to get there. But we're going to talk about briefly our 5 levels of financial freedom, but we're going to get into our 3-bucket framework. We've talked about that recently. In fact, we did a few shows on that topic. So we're going to return to that 3-bucket strategy. We're going to talk about building income streams that can help you in retirement. But here's the thing. We are facing an American retirement reckoning, but it doesn't have to be a catastrophe for you. And if you're ready to take action, stay tuned, because on the other side of this break, we're going to come back and we're going to talk about solutions. Hold tight.
Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
right, friends, welcome back to the program. You're listening to one of the longest running personal finance podcasts on earth. You can find us online at followthemoney.com. My name is Jerry Robinson, founder here at followthemoney.com, investor, trading coach, and also the author of the book Bankruptcy of Our Nation, where we talk about a lot of these things. You can find that book in the bookstore or on Amazon or right there on our website, followthemoney.com. Okay, so for those of you who've been with us for some time, you're very familiar with our 5 levels of financial freedom. And I'm not going to rehash those in today's broadcast because we've actually taken entire broadcasts and focused upon laying out our 5 levels of financial freedom. You can find the information about it on our website, followthemoney.com/5 levels. That'll take you right there. You can see all 5 levels where you begin to build a financial strategy that will get you to a good retirement, right? Financial freedom, which is the whole goal. And we do it a little differently than a lot of folks do. And that's why many people really enjoy our 5 levels. Now, we started a series on the 5 levels, the latest series we did. You have to go back to episode number 443. And starting in episode 443, we went through our 5 levels of financial freedom, and it takes you all the way to about episode 451. So from 443 episode to episode 451, right there you have really in-depth look at our 5 levels of financial freedom that takes you all the way from building an emergency reserve, making sure that you have the proper auto insurance and liability insurance and life insurance and wills and trusts, all the way down to building and diversifying a good 6 months liquid savings. And then, of course, investing, which is where many people get confused or drop the ball or just become paralyzed. They don't really know what to do. And so the 5 levels of financial freedom are a really great place to start if you are looking for a basic framework. So I will suggest that. Also, in episode number 470, we spent some time talking about some smart income strategies for retirement. So I also encourage you to check out episode 470 if you missed it, or go back and review it. But for today, what I want to do is I want to move in and talk about the things that you can control, right? We've already laid out the structural problems with retirement. We didn't cover everything, but we covered some of the big ones. And you can't control what? Well, you can't control the fact that we live in an economy that is dependent upon a fiat currency where productivity gains have been untethered from wages. You can't control that. You can't control the Social Security Trust Fund, and you can't control inflation, right? You don't have any control over that. And so if you get frustrated about those things, you might just throw your hands up in the air and say, well, I can't do anything. But that's not true. So you actually have the ability to control yourself and your own financial strategy. You can control where your dollars go, right? And so let me give you a framework that I use. It's very simple. We've talked about it before. As I mentioned, we talked about the 3-bucket strategy. We most recently did that in episode number 498, where we spent some time talking about safe money versus risk money. We'll get into that a little bit today. But let's talk about these 3 buckets. They really must be built in order. Bucket number 1, as you're preparing for retirement, one of the most important things that you need, and many people overlook this, it's not optional, and that is liquidity. That's your shock absorber, right? Cash. We're talking about cash, preferably in high yield savings, money market funds, short-term T-bills. This bucket is not built for big returns, right? This bucket is for your survival. If the roof leaks, right? If your transmission fails on your car, if you have a medical deductible, if a family member needs help, you don't want to be stuck in a situation where you have to sell stocks in a down market just to raise cash. You don't want to break a long-term plan for a short-term emergency, right? And most retirees and those who are nearing retirement often underestimate this bucket. They think, well, I'm invested, I've got money in the market, I'll just pull it from my portfolio, if I need some money. And that works until it doesn't. See, liquidity prevents you from being forced to sell at a very inopportune time. And forced selling, by the way, is exactly how most retirement plans begin to unravel. So at minimum, what I do is I want at least 6 months of income, monthly income in my liquidity bucket. I need 6 months of income. So if I'm used to having $3,000 per month come into my life, then I want 3 months, or I want 6 months of that. So that would be what, 3 times 6? That's 18,000. So at 18,000 at all times in my liquidity bucket. Now that's really important before retirement, but once you get into retirement, not only is it required, in my opinion, but I would even begin to put more into that liquidity bucket. That way you are always able to navigate those down markets when you're dependent upon that retirement account where you're pulling money out on an annual basis or whatever. The ability not to have to take too much, maybe just the required minimum distributions in the down market, if you have a traditional IRA or whatever, then that could actually work out very well. The whole point of the liquidity bucket is to build peace of mind. And you don't want to try to figure out how to make lots of gains in your liquidity bucket. That's where you put your cash at risk. Put it in things that are very safe and things that are highly liquid. That way you can access that money anytime you need it and take care of those expenses or emergencies or whatever. And in fact, in many ways, this liquidity bucket turns into a opportunity pool of capital that you can use in the event that something comes up that's great. Cash is king at the crash, as they say. He who has the cash is able to take advantage of opportunities. So having that cash not only protects you from emergencies that you might have and have to force sell some of your portfolio just to cover it, but it also gives you that opportunity pool of capital so you can take advantage of opportunities when they arise because you have cash on the sidelines waiting. Okay, that's bucket number one. I encourage everybody listening to me today to have 6 months of income, whatever you make in a month, multiply it by 6 and put that in a liquidity bucket. Again, you may say, well, I don't have a lot of money to do that. Well, that's what you really have to begin to do. This is in your control, right? All these other things are not in your control, but this is in your control. You can begin to save. And if you don't have enough saved right now, maybe you only got 2 months, make it your goal to get 6 months of income in that liquidity bucket. And don't worry about the fact that it might be like 18,000 or 20,000 or 30,000, whatever it ends up being for you in your situation. Don't say, well, I'm not going to be able to earn much money on that, so I just want to put that in the stock market. No, you want to keep that liquid cash and don't worry too much about the interest rate. I mean, if you can get a good high yield savings account or a good CD, fine. But don't stress out too much about the return you're getting on the liquidity bucket, right? That's not the important part. The important part is that you have the cash on hand, okay? We're going to have other buckets. Other buckets are going to be earning more money, but this first bucket is absolutely vital. We can't mess this one up. So bucket number one, build that liquid bucket of 6 months of income and keep it at all times forever. For as long as you are on this earth, you're going to need savings, right? So have that money available to you that you don't have to sell or force sell out of the market whenever things are down. Okay, let's move to the second bucket. The second bucket is what we call the safe growth bucket. This is all about stability, okay? And this is where many people miss it, in my opinion. We either view our money as savings, which is ultra safe, or we view our money being put in things that are, uber risky or highly speculative, but we don't really have much in the way of a middle ground. And the middle ground is really extremely important if you want a stable retirement. And this is where, in that safe growth bucket, that's where contractual guarantees live. Now, in a world like ours, where you don't get any guarantees from the stock market, you don't get any guarantees from the real estate market, you don't get any guarantees from the crypto market and on, precious metals market, no guarantees. Prices go up and down. Volatility is the only guarantee you've got, right? So if you can get a financial institution on the hook and they have to give you a contractual guarantee for your money, that is what we're talking about. That is safe growth money. And I want to be very clear about that word, contractual. That means that the outcome is guaranteed and is defined in writing. Let me give you a couple of examples of safe growth assets or safe money assets. Number one would be U.S. Treasury bonds that you hold to maturity. Another would be laddering Treasury bonds to create a different kind of income stream, that's laddered. You could also consider CDs, certificates of deposit sold by banks, held to maturity. These have contractual guarantees. The bank cannot just simply lose your money and say, oh, well, right? They can't go speculate it on something and say, oh, well, you lost your money. That's volatility. No, they have to give you your money back, right? So this is guaranteed. High quality bonds that are held to maturity, right? Assuming that there is some sort of guarantee in that. And then also certain fixed annuities. Many people don't like those words, annuities, or properly structured income annuities, right? There's a lot of different things that you can do in this safe growth bucket that are going to give you the ability to have a contractual guarantee. If you hold a treasury bond to maturity, the U.S. government is contractually obligated to return principal and interest. They don't have any way out of it. That's very different from owning a bond fund, right? A bond fund may fluctuate daily. The bond held to maturity doesn't care about any kind of volatility if you don't sell it. And then, of course, you can ladder treasuries so that one matures every year, and that creates a predictable income. Many people like to do that. Fixed annuities, as I already mentioned, they can provide guaranteed income streams that you can't outlive. Now, I know that many annuities are controversial, and some deserve criticism. Some annuities are horrible. I mean, some annuities you should definitely just simply stay away from, right? I am not a big fan of, and they're not all bad, but I'm not a big fan of variable annuities or some of these kinds of annuities that are exposed to the stock market and that you don't have a guarantee on the capital, right? That's not what I'm looking for. What I'm looking for is an annuity that is fixed. It may be indexed. It may be indexed to the stock market where I'm able to capture a portion, but it also has contractual guarantees that guarantee that I can't lose money, and they will write those in. So while many annuities are deserve criticism, many of them are poorly designed. When they're structured properly with income guarantees, that can transfer that longevity risk away from you. And that's something that's in your control, right? You don't control how long you're going to live, although I guess you do in some strange way. But in reality, you don't determine your health and your longevity. That's ultimately kind of out of your control. But you can transfer that risk away from you by having income guarantees, some sort of product that says, look, we're going to keep paying you until you're no longer on this earth, right? And we're going to pay you every month. That's what Social Security is, right? That's, in essence, what an annuity properly structured should be. By the way, the reason why many annuities I would recommend staying away from, not all, but many, is oftentimes not due to the product itself. Oftentimes, it's due to a lack of expertise on the part of the annuity salesman, right? And oftentimes, they'll structure these in a way that actually benefits them and benefits you less, right? So, and that's definitely a problem. So, I'm in the camp where if you're going to buy an annuity, you want the person who is selling that to you to know exactly what they're dealing with. These can be very complex products. And so, but again, they serve that great purpose of creating a bucket that exists to cover your essential expenses, housing, utilities, food, insurance, all your baseline healthcare. If the markets fall 30%, this safe money bucket is not going to be affected, right? Because you got contractual guarantees. It protects you from the sequence of returns risk. Because if you retire, as I mentioned, into a bear market and you're withdrawing from a volatile equity portfolio, you may permanently harm that portfolio, right? And that is just straight up math. That's something that you don't want to mess around with. So and this is the power of the safe money bucket, is that when the markets are down, you can lean more into that safe money bucket. And when the markets are up, you can lean more into that risk growth bucket, right? It all depends. So it allows you to be nimble and not be just, okay, all I have is this IRA, and so now I have to take money out of it because I don't have any other money. I don't have any other assets. So when the market's down 30% and I got to go cannibalize this thing because I don't have any other income sources, right? Well, the safe money bucket will give you additional income sources. That's the power of it. So let's move on to bucket number 3. Once you've got your liquidity bucket and you've got your safe money bucket, then you got your risk money bucket, your risk growth bucket. So this is where most people just want to immediately put money into. And I get it, because you can get the highest rate of return here. This is definitely going to be the highest rate of return that you're going to get. But of course, the trade-off is what? No contractual guarantees, right? You put money into a stock market, stock goes down, goes out of business, there's no cavalry coming to save you, right? In other words, you're out of luck. So at the same time, if you do well, then it's uncapped. You don't have any kind of cap. Like, you can literally just make as much money as that asset does over time. And so it kind of cuts both ways. So anyway, if we're really trying to tackle that inflation risk, that risk growth bucket is where it's at, right? Equities, we're talking about stocks here. Low cost index funds, much more than these target date funds, guys. You really want to focus more on these low cost index funds, much cheaper, the fees are lower, and over time, they just perform much, much, much better, in my opinion, and based upon the data that I've seen. Dividend growth stocks, right? Dividend aristocrats. These can be a good place to go. Real estate, right? Real estate. If you like real estate, that's a great place to be investing in your risk growth bucket. And I would suggest that you have other things, not just all stocks, not just all real estate, but to diversify it so that you, again, have a diversified pool of assets to tap based upon whatever is going to come our way. It allows you to be nimble. Your own business. I encourage many of you out there today to consider owning your own business. If you're a W-2 employee, obviously you don't have the ability to raise your income whenever inflation rises. You might have a boss who says, well, I'll give you a raise, but if he doesn't, guess what? You're out of luck. You can't get a raise. So without the boss saying yes. So in other words, if you have your own business, well, you can raise your prices, right? You can keep up with inflation. The same thing when you own real estate. If you own a piece of rental real estate, you can raise the rent when inflation goes up, right? So it allows you to inflation index your income. Well, that's a huge part of, being an investor and or a business owner, is that you're able to keep up with inflation in some way. So that's my point, is that this risk bucket participates in the productivity gains largely. Remember what we talked about earlier? Asset owners, they capture a large part of the productivity gains, unlike wage earners, which do not. So if you're a W-2 employee and you do not own, assets, or you're not building out an asset strategy of buying real estate or stocks or, whatever, or starting your own business or whatever, then it's going to be very difficult for you to outpace inflation. If you want to outrun inflation over the next 20 to 30 years, you really need exposure in this risk growth bucket. But this bucket, as I mentioned, needs to be sized properly. Many people will not have anything in liquidity, right, in the liquid bucket. The safe money bucket, they assume they don't need, and then they put all their money in the risk growth bucket. And then when life happens and the market's down, they got to cannibalize the account and they have to start all over, right? That's a negative thing, or it gets cut in half, or it's something like that. And so the point is that you really want to size these buckets properly. You want 6 months of income in your liquid bucket at all times, right? If you have to use that money, you stop the press and you go fill up that liquid bucket and you keep it 6 months of income at all times. No matter what, that has to be full, right? The second bucket, as you get closer to retirement, the size of that second safe money bucket should get bigger. Your risk growth bucket should be bigger than your safe money bucket when you're younger. And then as closer as you get to retirement, the more that the risk growth and the safe growth should be starting to come more into balance, right? So you really want to get some contractual guarantees. Once you've built the assets, the whole key is don't lose them. So you start moving some of that cash that you've built up through risk growth and you move it over to the safe money bucket so that you actually then lock it down with contractual guarantees so you can't lose it. I've seen many people who have put a lot of money in the risk growth bucket and then over time, something happens and then they don't have any contractual guarantees, something goes wrong, and all that hard work just goes right up because they didn't have any contractual guarantees on it, right? So retirement, once you get to retirement, that's not the time to chase speculative hype with all your money, right? That's the place where you want to be still having some speculation. Of course, there's nothing wrong with that, even in retirement, but it needs to be a a certain portion of your overall assets, and it needs to be a relatively small part, right? Because you don't want to work so hard only to lose it due to over speculation as you get older, right? You want to control those drawdowns by focusing on high quality assets in the risk growth bucket, but then also making sure that you are not putting too much at risk there, right? That's a way you can control drawdowns. You want to focus, as I mentioned, on high quality. Low cost index funds often outperform high fee target date funds over time because fees compound just like the returns do. One of my good friends and part of our advisor referral service here, Barry James Dyke, really great financial advisor. He's been out there helping people for so long. He's spoken at our Follow the Money conferences over the years. He's been a guest here on this podcast several times, and he's helped many of you who've reached out to us for an advisor. And we have a stable of great advisors around the country that we'll put you in touch with if you're wanting to find somebody. Say, hey, I need to figure out my bucket strategy here. I don't have enough money in the safe money bucket. I need to figure out how to what I might want to look at. Do I need to look at certain kinds of bonds? Do I need to look at certain kinds of CDs or annuities? What do I need to do? And that's really thing. But anyway, Barry James Dyke, he's done some excellent work showing how these target date funds layer in fees and create a lot of issues that many people don't realize. It doesn't always serve the investor. So obviously that's something to keep in mind. Simplicity really usually wins. So when it comes to your risk bucket, number 3 there, that third bucket, within that bucket, dividend income can supplement your cash flow. But remember, dividends aren't guarantees. They can be cut. So no one's guaranteeing you anything in this risk bucket, right? This is also where I think Roth accounts matter. Roth contributions, if you qualify, is a huge benefit to people who are nearing retirement or as they are moving towards retirement. Once you get to retirement, if you have a Roth IRA or a Roth 401k, then you're able to pull that money out tax-free. You put the money in post-tax, and then you pull it out tax-free. The reason why that's so powerful, as I often say on this broadcast, is the fact that would you rather pay tax on the seed that you're getting ready to plant, or would you rather pay the tax later on the harvest from that seed? And the answer, it couldn't be any more clear. You'd rather pay the tax on the seed, not the harvest from the seed, right? Because that would be a lot more. Well, that's what the Roth is. The Roth allows you to pay the tax up front on the seed as you put it in. You don't get to write it off on your taxes. You don't get to, get any kind of benefit for putting money in a 401k today. But when you pull it out, you get a huge benefit in the fact that there's no tax. There's no tax on any of it. The principal, the growth, all of everything that's made in that account, it's all tax-free. If you meet the requirements that are required. Of course, there's rules that you have to use, but future tax-free income is huge. You can also execute a Roth conversion, and that's extremely important, I would say, for many people, especially if you're nearing retirement, getting close to retirement. A Roth conversion can really make a difference, and there's no limit on that. And so there's a lot of benefit there to create future tax-free income. And of course, tax diversification matters big time in retirement. So if all your money is, say, in a traditional IRA or traditional 401k and you don't have any Roths, well, then those required minimum distributions later in life can really push you into a higher tax bracket. So, if you do have some traditional and you want to keep that money there, well, then having some Roth on the side will help you, because when you get to retirement, those requirement, minimum distributions can kind of get pesky and they can really affect your overall tax bracket. Roth accounts will give you the flexibility to help reduce that risk. Now, there's the 3 buckets. Again, I've done teachings on this. The latest one we did was episode 498, Safe Money versus Risk Money. I strongly encourage you to go back and listen to that one too. But let's tie all this together. We have 4 major retirement risks. There's more, but the ones I want to focus on today are longevity risk. That is, that you may live longer than you expect. So therefore, you better have enough money in retirement just in case. The sequence of returns risk, right? We talked about that one. Early losses combined with withdrawals can be devastating to your account. There's number 3. There's inflation risk, right? 2 to 3% annually cuts purchasing power in half over 20 to 25 years. So if you're in retirement and you enter retirement with $1 million and you are in retirement for 25 years, that's really only about $500,000 by the time you get to the end of the 24 years, right? So it gets cut in half. It erodes. There's eroding factors on money. Okay, then there's also the 4th retirement risk, which is the healthcare shock risk. One bad diagnosis can destroy a plan that is fragile, if your plan is not rock solid. So a properly structured 3-bucket strategy addresses all 4 of these retirement risks, right? Liquidity is going to help you absorb the shocks of life, all these uncertain shocks that you're going to face. The safe growth bucket is going to provide you a stable income that allows you to not have to reach into your risk growth bucket at an inopportune time just to get some cash. The risk growth bucket, that number 3 bucket, that's going to combat that inflation risk, because this is one of the only ways to stay ahead of inflation is to invest in assets that are going up historically more than inflation, i.e. stocks, i.e. real estate, i.e. your own business, right? And also thoughtfully thinking about your Social Security income. If you ever get those letters in the mail from the Social Security Administration where they tell you what your expected a benefit is expected to be when you retire and your age, keep those letters. Those are very important. Show them to your financial advisor. That's something that you really want to keep up with. Even create a login for Social Security. Start paying attention to that. But you can also optimize that. You can delay when it's appropriate. Many people will delay taking their Social Security so as to optimize the amount that increases your guaranteed lifetime income. There's all kinds of ways to optimize Social Security. We've talked about that before here on the show. But remember, retirement should not be about chasing returns, right? That's not what you're doing. If you're trying to retire, if you're trying to build a retirement plan, you're not chasing returns. That can actually get you hurt. What you're actually doing is you're managing for these risks. You're a risk manager, right? And so you're managing the risk of all of these things that could happen, right? The sequence of return risk, you're managing that risk. The longevity risk, you're managing that risk as someone who is planning for retirement. The inflation risk that you face, the healthcare shock risk, this is what you're doing. You're not chasing returns. You're a risk manager. And then, of course, there's a psychological piece we need to bring in too, because when retirees know where each dollar is and what its job is, that brings down your anxiety level. Don't spend your whole life working to simply create a retirement plan that makes you stressed, right? Confusion is going to fuel fear, and fear is going to cause you to make poor decisions, right? Whereas if you have a solid plan, that's going to help you build confidence. You can't obviously eliminate uncertainty, but you can be a good risk manager that anticipates it. And you can design a plan that can be resilient. So a lot of things are out of your control, friends. But the things that are in your control are where you can get started today. All right, friends, welcome back to the final moments of today's broadcast. I hope you enjoyed today's episode. Again, probably one of the most important financial conversations all of us can have, particularly here in America, where we have such a reckoning in the retirement space and lots of risks that we have to manage for. So as we close out today's broadcast, let's just kind of bring it home here. America is facing a retirement reckoning. It's not because people are foolish. It's not because they are lazy. It's because the system has shifted beneath our feet, right? Wages have not kept up with productivity. Healthcare costs just keep rising. Markets remain volatile. And that's the only certain thing you can guarantee about markets, is that the volatility is going to continue. Social Security, the government promises made to you, those are facing strains. And yet the responsibility for all of it falls upon you, the individual. There are no pensions, or there are, I guess, a few, but there's very few pensions anymore. It's really up to you to build your own retirement account. And this is a difficult thing for many people, especially when we're not trained in how to do this in high school or even in college. They don't even teach you how to write a check. We have great financial illiteracy in this country. And again, I don't place the blame on every single individual. We live in a very strange economy that is unusual from times past. And nevertheless, despite all of that, as I mentioned, the responsibility still falls on the individual. That's the tension of our time. You can't fix Washington. You cannot rewrite monetary history. You can't control inflation. You can't predict the next bear market. All you can do is design a plan wisely, right? You can build liquidity before you start chasing yield, right? You can work on building out that 3-bucket strategy, right? You can do it. You can control risk before volatility controls you. And remember, retirement is not simply just chasing returns. It's a risk management strategy that stretches out across decades. And if you approach it casually, the market is not going to be kind to you, right? Which brings me to our final word. Warren Buffett, who, by the way, is stepping down now as the chairman of Berkshire Hathaway, once said this: "Only when the tide goes out do you discover who's been swimming naked." Now, that's a clever line, right? But it's also a brutal line when you think about it. Bull markets, they definitely hide the weakness that might be lying underneath the market. And cheap money, of course, hides bad decisions. And low volatility hides over exposure to the markets. But when the market's correct, and when healthcare costs spike in your house, and when inflation lingers too long, like we've been seeing it lately, then suddenly you begin to see who's been swimming naked, right? If your retirement plan depends upon a perfect market, a perfect health, low inflation forever, and low taxes, that's not a plan, right? That is hope. And hope, as I've often said, is not a strategy. The tide will go out again, and it'll come back, and it'll go out again. It always does. The question is not whether volatility is going to be here to stay. The question is whether you are prepared when it does. And that is just something to think about. Well, that brings us to the end of today's episode. It's been a great pleasure to be with you here today. If you want to check out more of our episodes, be sure to go online, followthemoney.com. I encourage you, by the way, to check out episode number 498. We just made it several weeks ago. Safe money versus risk money, if you want to drill down even deeper into that topic. Or you can go back to episode number 443 and go through episode 451 and cover all that 5 levels of financial freedom. If you're in the mood to tackle this topic here at the beginning of the year, now's a great time to revisit some of these episodes, get your plan together. And by the way, we're here to help you. If you have questions along the way, if you need to be put in touch with a financial advisor who understands all the things that we're talking about, if you need help building out your bucket strategy, whatever the case might be, you can always reach out to us as well. Just go to followthemoney.com/advice, and you can get advice from us right there. We'll put you in touch with somebody who will reach out to you very shortly. And there is no cost at all to speak with someone from our advisor referral service. Followthemoney.com/advice if you're interested in that. Otherwise, friends, remember, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.